If you tap your card in Zurich or shop online in Paris, chances are your payment runs through just two American companies, Visa or Mastercard. Together, they handle the vast majority of card payments outside China and are worth hundreds of billions of dollars. How did we end up with only two U.S. firms dominating card payments worldwide? And more urgently for Europeans, what is being done to challenge this control?
In this episode, we'll quickly cover how Visa and Mastercard built their duopoly, how their business model works, and why banks and merchants have stuck with them. Then we'll look at Europe's fight back, from new regulations to a homegrown payment network called Wero, and the rise of account-to-account and open banking payments. Finally, we'll imagine a future where Europe controls its own payment rails, and the card duopoly is just one option, not the default.
And along the way, I'll jump in to explain why all of this matters, not just for policymakers, but for banks, fintech founders, and investors trying to read where the next wave of disruption is coming from.
I'm your co-host, Mark Canlish.
I'm Brian Welchley.
And I am Matilda Santos, and we are your hosts today.
The story starts in the 1950s. Diners Club launches the first modern charge card, followed by American Express. But the real foundations of today's system appear in the 1960s. Bank of America spins off its Bank AmeriCard franchise, which becomes Visa. At the same time, a consortium of banks creates the Interbank Card Association, which will later be rebranded as MasterCard. Crucially, these networks are born inside big U.S. banks. That gives them thousands of branches, millions of customers, and deep relationships with merchants right from day one. Early contracts are restrictive, banks choose a side, and by the time electronic payments spread globally, Visa and MasterCard already sit at the center of the system.
Think of them as the railroads of digital payments. Their power is all about network effects. The more consumers carry Visa or MasterCard, the more merchants feel they must accept them. The more merchants accept them, the more banks want to issue those cards. Over decades, this snowball turns into near-universal acceptance. Even where national card schemes exist, they often have to co-badge with Visa or MasterCard so that cards will work abroad. The result? If you want to sell to tourists or do cross-border business, you almost can't avoid the big two.
Why does this matter? Because once a network reaches that level of ubiquity, it's incredibly hard to dislodge. Newcomers don't just have to be good, they have to be accepted almost everywhere from day one, or they feel unusable to consumers. That's the true moat around the Visa and MasterCard business.
Let's look at the money. Every card transaction involves 1. The customer's bank, the issuer. 2. The merchant's bank, the acquirer. 3. The card network in the middle. When you pay, the network routes and authorizes the transaction, then helps settle the funds. For that, lots of little fees are taken along the way. A big one is the interchange fee, often around 1% or more, that flows from the merchant to the card-issuing bank. That's what funds your airline miles and cashback. The networks themselves usually take a smaller slice on each transaction, plus fixed fees and service charges. But at global scale, a few tenths of a percent on trillions of dollars becomes enormous revenue. Because the infrastructure is largely digital and fixed cost, profit margins are extraordinary, among the highest of any large listed company.
There's also a deep symbiosis with banks. Originally, Visa and MasterCard are owned by banks and later become independent public companies. But the relationship never goes away. Banks issue the cards, they earn interchange fees, and they use rewards to push more card spending. The more people pay with cards, the more everyone in this ecosystem earns. Merchants complain about fees and sometimes threaten revolts. Think of big retailers publicly pushing back on card costs. But in the end, most feel they have no choice. Customers expect to tap a card, so the merchant pays the toll.
This alignment between banks and networks is one of the main reasons the duopoly has lasted so long. Everyone on the inside gets paid. Any alternative, especially a cheaper one, threatens that revenue stream. So new systems don't just fight technology or regulation, they also fight the financial incentives of the incumbents.
Despite their strength, the duopoly is under more pressure than ever. Governments and regulators have stepped in, especially in Europe, capping interchange fees to reduce costs for merchants and consumers that has already squeezed banks' card revenues. At the same time, tech companies created new ways to pay. Digital wallets like PayPal, Apple Pay, and others promise to let you pay directly from your balance or bank account. Buy now, pay later firms like Klarna and Affirm let shoppers slice purchases into installments.
But here's the twist. In many cases, these alternatives still ride on the same rails. Most wallets are funded by cards. Many buy now, pay later repayments are made with debit cards. So even when the user experience looks new and shiny, Visa and Mastercard often stay in the background, collecting a fee each time money moves. And they don't just sit back. Both networks invest heavily in real-time bank transfer systems and open banking platforms. They want to be present wherever money flows, card or not, so that if consumers migrate to account-to-account payments, the networks still earn a toll.
For innovators, this is the key lesson. You don't beat a duopoly just by building a nicer app on top of its rails. At some point, you need new rails, a different way to move money, with different economics and governance. That's exactly where Europe is now focusing its energy.
Europe is both a goldmine and a headache for Visa and Mastercard. Card payments are the most widely used electronic payment method in the EU, and a majority of those transactions run through the two American schemes. In some EU countries, there is no domestic card system at all. Everything goes via Visa or Mastercard. That concentration has raised alarms. It's not only about high fees, but also about strategic autonomy. A dramatic example came in 2022 when services for Russian cards were cut off as part of sanctions. It showed how quickly access to global card rails can be switched off. Europeans started asking, what if our own payments one day became collateral in a geopolitical dispute? The flagship European response is the European Payments Initiative, or EPI. Its consumer-facing brand is a digital wallet called Wero, W-E-R-O. What's different about Wero? It is built on instant account-to-account transfers, not cards. Money moves directly from the payer's bank to the merchant's bank in seconds. That removes several intermediaries and can sharply reduce costs. Pilot launches started in 2024 in countries like Germany, France, and Belgium, embedded directly inside major banking apps. Instead of forcing users to download something new, Wero piggybacks on apps people already use, and in some markets it rebrands existing local payment tools into a single European standard. Over time, the plan is for Wero to cover person-to-person payments, in-store QR, or tap-to-phone payments, e-commerce checkouts, subscriptions and recurring bills, loyalty and other value-added services.
An EPI is just one piece. European regulation under PSD2 opened bank APIs to third-party providers, creating the open banking movement. Now fintechs can initiate payments directly from bank accounts, with the customer's consent without relying on cards. Klarna's deals with large German banks to enable more flexible recurring account payments are a good example. Instead of a gym membership charging your Visa each month, it could be a smart, permission-based pull from your bank account, settled instantly with no card network involved at all. Meanwhile, Europe's SEPA Instant credit transfer system allows euro payments in seconds across dozens of countries. Regulators are pushing to make instant transfers mandatory and cheap. Combine instant payments with open banking, and you get a powerful alternative highway for digital payments. Across Europe, we already see local success stories. Ideal in the Netherlands dominating online payments by direct bank transfer, Swish in Sweden, Mobile Pay in Denmark, Twint in Switzerland for mobile payments. The challenge now is to turn this patchwork into a unified, cross-border alternative at scale.
This is where Europe's strategy gets interesting. It's not just trying to copy Visa and Mastercard with a European card. Instead, it's using regulation and new technology to leapfrog to instant account-based payments. If Europe can standardize this across borders, it doesn't just lower fees. It changes who controls data, who sets the rules, and who captures the upside from innovation. For banks and fintechs, that opens a huge design space. From programmable payments and smarter subscriptions to new lending and loyalty models built on top of instant rails.
Let's fast forward to, say, 2030. You're in Milan buying a coffee. Instead of pulling out a Visa card, you open your banking app or the Wero wallet on your phone. You tap, scan, or accept a request to pay. The money moves from your bank to the cafe's bank in a couple of seconds. No card number, no CVV. The merchant pays a tiny infrastructure fee instead of a chunky percentage. Your loyalty points, receipts, and maybe even your digital ID are all handled within the same interface. Travel to Rome and the same app works. No foreign card fees, no reliance on American networks in the background, just instant transfers across a European rail system.
Visa and Mastercard don't disappear, but they're no longer everywhere. They still support classic credit products, tourists, and some international corridors. But for day-to-day European commerce, they're just one option among many. Europe joins other regions like China and India in running its own core payment infrastructure. Over time, you could imagine these regional systems linking up, a network of networks that bypasses traditional card rails for a big part of global trade.
Is this guaranteed? No. Old habits are sticky, and the incumbents will fight hard. But the direction of travel is clear. If consumers get a simpler, cheaper way to pay, backed by their existing banks and supported by regulation, they will gradually shift. Merchants will accelerate that shift if it saves them real money. And once new rails reach critical mass, innovation tends to compound on top of them, just as it did on card networks decades ago.
Visa and Mastercard built two of the strongest businesses in the world by turning payment networks into global toll roads. Europe is now trying to redesign the road network itself. That won't happen overnight, but the combination of regulation, bank collaboration, and fintech innovation is already reshaping the landscape.
So what does all this mean in practice? Let's break it down for three groups. 1. Policymakers and regulators. You're not just refereeing a market, you're effectively helping design its infrastructure. Policymakers and regulators need to enforce competition and fee caps where needed, push instant payments and open banking standards, and projects like EPI that create true cross-border alternatives. The big risk is fragmentation. 20 clever national schemes that don't talk to each other won't beat two unified global giants. Coordination is everything. 2. Banks and fintech founders. For banks, clinging only to interchange revenue is a shrinking strategy, especially in Europe. New rails offer a chance to reduce dependence on external networks, own more of the customer data, and build new services on top of instant account-based payments. For fintechs, the opportunity is to become the user experience and intelligence layer on these rails. Seamless checkout and subscription experiences, rich fraud and risk analytics, and embedded finance inside other apps and platforms. Think in terms of partnerships and interoperability, not 1,000 isolated wallets that each try to be their own mini-network. 3. Investors. Europe's payment system is being rewired in real time. That doesn't happen often in a market this large. Value will shift from pure card fee collectors to infrastructure providers for instant and open banking payments and to software layers that help merchants and banks ride the new rails. The duopoly won't vanish, but even a modest shift of volumes off card rails represents huge transaction value moving through new channels. And that's where the upside is.
A few decades ago, hardly anyone would have predicted that two card networks would quietly sit under most of the world's everyday spending. Today, Europe is asking whether that setup still makes sense, economically, technologically, and geopolitically.
The answer isn't just cheaper payments, it's about who controls the lifeblood of commerce, and whether a region as large as Europe should depend on foreign private companies for that critical infrastructure.
For now, Visa and Mastercard still look incredibly strong. But between instant payments, open banking, and Europe's determination to build its own rails, the story is far from over. If you enjoyed this episode, share it with someone who thinks payments are boring. Because as you've just heard, the battle over your morning coffee tap might be one of the most important economic stories of the decade.
This podcast was produced by Asif Rajani and brought to you by Eurotech.vc, empowering Europe to lead the global tech race.